Welcome to our webinar today on financial literacy and behavior for adults and young adults. This is Jim Bell, founder and president of Bell Investment Advisors.
And I'm Heidi Stoltz, investment advisor with Bell Investment Advisors.
We want to show you an overview of what we're going to cover today in terms of these four different areas. And this webinar is going to be a little bit longer than we usually broadcast. It should be about 50 minutes, 50. If you're having any trouble with audio or visual part of this, please call our office at 800-700-0089, 800-700-0089. We're going to start by talking about dignity as a philosophy or underlying principle. And I want to give credit to Operation HOPE, which is a national community service nonprofit that we support here at Bell Investment Advisors. Operation HOPE identified dignity as the foundation of what it means to achieve financial literacy and behavior. And we've been very impressed with their approach, so we are using it here today in our presentation. So what is dignity? Dignity is the quality or state of being worthy of esteem or respect. And for myself personally, my two children were born in the 1970s, and that was a period where there was a strong, I call it the self-esteem movement. There was a strong emphasis on self-esteem for children. And one of the things that was a little bit missing in that conversation, as far as I'm concerned, is that self-esteem is something that you achieve by behavior, by performing esteemable acts. Self-esteem and dignity are things that need to be earned. It can't just be bestowed on people. It's how people act, do what they say what they do. I wanted to make that point at the beginning here, that dignity is something that is earned through behavior. We've created this presentation somewhat like a workbook, so you're going to see plenty of open questions to you, our audience, and we'd like you to reflect on these and perhaps answer them in your own words. So what does dignity mean to you? The first thing that comes up for me is the concept of stewardship, that we're all given certain gifts and talents, and stewardship is about taking care of what we've been blessed with and honoring that and fulfilling it. In many respects, I think of money and finance as a gift that we can use to develop capacity for ourselves, to take care of ourselves, to take care of our families, to take care of what we care about. So for you to reflect on, what would it mean for you to live a dignified life, and why is dignity important? These are important questions, to be sure, for all of us to answer. On this next page, we're asking you to think of 3 examples from your own life of people who live with dignity. And the first one that I'll share is about a family that we work with here at Bell Investment Advisors. And the parents have 3 children. They're all in college at the same time. So you can just imagine what kind of an obligation that is for a married couple to pay for all three different tuitions simultaneously. And this particular family demonstrates dignity from my point of view in that they really thought long term, they planned ahead, they made sure that they had enough money set aside so they could educate their 3 children all at the same time. And one of the best parts of the story is that the children have recognize this, that at the different colleges where they go, they have other students, friends, who experience financial stress, like their families are having difficulty making the tuition payments on time. So you can just imagine what kind of pressure that puts on the child and the parent. And these particular children who don't have to face that have expressed gratitude to their parents for being so disciplined and caring that they made sure that they didn't have to suffer that kind of stress. Heidi, I think you have an example that you want to share.
I do. Thanks, Jim. So when I think of dignity, I think of my grandmother. She's definitely been through some struggles herself, but as I've watched her, she's always doing things in a methodical way, and even though she has struggled, she always treats others and herself with respect and just carries herself with a lot of dignity.
Thank you, Heidi. So this next question about what does financial responsibility mean to you, and I'm going back to this concept about stewardship. One of the things that pains me is that, you know, I'm aware, so kind of on a national basis, that there are many students who are talented enough to receive athletic scholarships, for example, and they're given an opportunity to not only play the sport or sports that they love, but also to get a first-class education. And it pains me when they don't, when they blow that off, or they don't take advantage of it. I mean, that would be true of academic scholarships as well. There's many students that are going to good schools. There's many really good public schools, but they don't appreciate what that opportunity means to them. So these are important aspects of what we mean by dignity. And finally, what is the relationship between dignity and financial responsibility? And again, this brings up themes for me of discipline, maturity, being trustworthy, being able to delay gratification. One of the aspects of maturity and growing up is that you realize you don't have to go out and buy everything every time you want something. There is such a thing as planning and saving and being disciplined about how you spend your money. So we wanted to give some examples of what financial responsibility looks like under the umbrella of dignity. So certainly saving money each month is a dignified act. Planning for the long term, like these parents I mentioned that put money aside week after week, month after month, so they could educate their children. Contributing money or time to a charity. Recognizing that we all exist within community and that community is a support to us, and it's important to cherish that and give back to it. Working more in order to make more money if that's necessary or required, and certainly we all know families that have worked really hard, worked maybe 2 jobs to make sure that their children would be taken care of and be able to live a better life. In the opposite category, there are behaviors that are undignified or irresponsible. So borrowing more money than you can afford to pay back, or paying more money than necessary to purchase something. That's not good stewardship. You want to protect your gifts and rewards and use them wisely. So being a good shopper is something that we would think of as expressing dignity. And finally here, neglecting to pay back money that you borrowed it is a terrible way to sully your reputation in life. And we'll talk more about that as we go along here. Our belief is that we don't all need to be rich. You may not need to be rich, but we all need to have enough. So there's a key question about how much is enough and what is enough. And that's a personal assignment, so to speak, that we all need to determine for us. It reminds me of an interesting study about money and happiness that determined that once people earn about $75,000 a year, that's kind of the peak of efficiency in terms of how happy can money make you. If you make a lot more than that, or as you make more and more beyond $75,000, it doesn't contribute as much to your happiness as that first $75,000. So that's just an interesting anchor point. So that's what we wanted to share about dignity. That brings us to our first category about budget or budgeting. And sort of a transition question here is, how does not having enough money to pay for what you want or need affect your dignity? Again, going back to this family that I referenced, you can just imagine for the children who are under the stress of knowing that their parents really can't afford to make the next tuition payment, that creates a lot of unnecessary stress in our view. But back to a budget or a spending plan. A lot of people prefer to think of budgets as spending plans. It's less negative or onerous. But what we're talking about is a written plan for managing your income and expenses to avoid debt. Budgeting helps you make sure you don't spend more money than you make. One important distinction in the field of budgeting is the difference between gross income and net income. So gross income as an employee is the total amount that your employer pays you on the paycheck before any deductions are taken. Net income is what you actually get to take home, and what is left after deductions like taxes, health insurance, retirement contributions. And net income is what you will factor in your budget. So we wanted to show a sample pay stub just to give you a point of reference here. This is what a check might look like, or the stub of a check that you might get every 2 weeks or twice a month from your job. So it shows the gross income and then all of the withholding amounts, which are deducted from your gross, the $524 in all these different categories. And you end up with a net of just over $934, which is what you would factor into your budget. This is a very important principle. Pay yourself first. This makes a huge difference. It has in my life, certainly, where in terms of your spending, the first thing you should do is set aside as much as you can afford in the category of savings, whether it's savings for retirement or savings for education for yourself or your children. Those things should come out of your paycheck first, or out of your net income. In my younger years, I used to try and see how much was left over at the end of the month, and whatever that was, that's what I would try to save. It didn't work very well. I can tell you that by the time I got to the end of the month, I'd usually spend it all. So that's what's important about paying yourself first. Another important distinction in this area of budgeting and spending is that it's important to understand what it is that you need versus what it is that you want. So needs are fundamental. They're crucial. You can't really live without a place, a home, whether it's an apartment or a home. You're going to have to pay your rent or your mortgage. We all need to eat, groceries. Education is crucial for all of our futures. These are examples of essential expenses. Wants, on the other hand, are more discretionary. They might be considered more luxury. How often do you eat out in restaurants? We all know that it's more efficient to buy groceries and cook at home. Not that we shouldn't go out for restaurants, but it should be according to some plan or discipline. How often do you go to the movies? You need to be able to afford to do these things. So that's where budgeting is an example of planning, so that you don't get into trouble by spending more than you earn. We've included here a basic budget worksheet to show different categories of expenses and 3 different columns so that you can track what you're currently spending money on, what your revisions might be, so that you end up with with more at the bottom than you're spending, so that you're able to save, and then what's your actual spending amount. So that's a worksheet that we hope you might find useful. In terms of net income and total monthly spending, these worksheets are designed to give you the possibility of comparing the two. The goal here is that you want to spend less than you make, and you want to be able to save money. If your net income is, or if your spending is more than your net income, you're going into a deficit and you're getting into debt. We've talked about the importance and power of education, so we wanted to show you what this actually looks like on average in the United States, that just the power of education for individuals on average in the United States who have had some high school but didn't graduate. Their average incomes are $23,000. If they did get a high school diploma or a GED degree, it jumps up to $30,000. If they have a 2-year associate's degree from a community college, the average goes up to $35,000. A bachelor's degree will average $46,000, and a master's degree $55,000. That's just a really important illustration from the Department of Labor of the importance of education, certainly financially. Okay, Heidi's going to talk to us about banking.
Thanks, Jim. So we've talked about budgeting, and we know that you work hard to earn your money, and we want to have you put that money somewhere that's safe and secure. There was a recent study done, and it showed that about 8% of Californians were either underbanked or unbanked, which means they didn't have access to mainstream financial services like banks and credit unions. So if you're unbanked, that means you probably have a lot of cash at home. That cash is vulnerable to being lost or stolen. And if you're getting a paycheck every month or every 2 weeks, you might be using check cashing stores. Check cashing stores can charge expensive fees. Payroll checks usually will be 1.5% to 3% fees to get those checks cashed. So if you're taking home $30,000 a year, paying 2% per paycheck, you're paying the check cashing store $600 in fees per year. So we want to avoid that if we can, put the hard-earned money somewhere that's safe and secure. So there are 2 ways to do that. You can go to a bank or to a credit union. There are slight differences between the two. So this chart is showing us that a bank is company-owned, so it's a for-profit institution, whereas a credit union is going to be member-owned, and it's a nonprofit. Subsequently, credit unions may have lower fees than banks have. Both institutions provide insurance on the deposits that you put in, and that'll be $250,000 per individual per account. So when you're going to a bank or a credit union, you're going to want to choose the least expensive account that's still going to do what you need it to do. It's going to meet your needs. So before you go, it's good to have a list of questions ready, and you'll ask these questions to the bank or the credit union to make sure you're getting what you need. We've provided a list here. One question could be, is there a monthly or an annual maintenance fee? And if so, how do I avoid that? Do I maintain a minimum balance? If so, what is that minimum? Is there a fee for receiving paper statements? And if so, can I sign up to receive those over email? Is there a minimum balance fee? If I go below a minimum, am I going to be charged? And if so, what is that minimum? And then lastly, is there a fee for speaking with a teller instead of using the ATM? So these days, banks are trying to encourage people to go online, to go to the ATM, and oftentimes if you speak to a teller more than a certain amount of times, they will charge you. So it's good to be aware of those things. So a checking account, what is a checking account? A checking account is going to be kind of a transaction account. It's going to be for your day-to-day transactions. It's with a bank or a credit union, and basically it's going to allow you to pay your bills. So you can transfer money from your account to the accounts of your payees. You can do that by paper check or electronically. And you're using that account to manage your cash flow. A debit card is going to be a card that's linked to your checking account. So you may also hear these called check cards. And they allow you to make deposits, take money out, authorize electronic purchases, like if you're shopping online on Amazon, for example. One important point is that money paid by your debit card is subtracted directly from your checking account. So it's very convenient. You don't have to carry cash or checks, but it's important not to overspend with the debit card. You don't want to go below your checking account balance. Another option to give the convenience of a card but not be linked to a checking account is a prepaid debit card. So a prepaid debit card, again, not linked to a checking account, but you can still make electronic purchases and withdraw cash. Sometimes prepaid debit cards can be refilled and used again, but typically they're just used once. So when we were talking about the debit card and how the purchases came right out of your checking account, it's leading us to this question: what does it mean to get a non-sufficient funds notice? And this can also be called an overdraft notice. This means that your checking account balance was too low to cover those purchases or those withdrawals that you made. So every bank and credit union is a little bit different, but typically they'll charge you a non-sufficient fund fee, and that's usually around $30. So again, very important to avoid that situation. Overdraft protection is kind of like a line of credit that banks will offer their customers to cover those overdrafts. So instead of rejecting that purchase, the bank will allow you to make that purchase and will extend you a small line of credit until you are able to cover that balance that you didn't have in the checking account.
Thanks, Heidi. So this next area we're going to cover is the area of credit. So a credit-worthy person is a dignified person who is willing and able to repay debts and interest. So more distinctions, we want to make a delineation between different types of debt. Some debt is very useful and productive. Other debt can be in a negative category of working against you. So borrowing money to enhance your education certainly falls into the area of a positive, dignified debt. Borrowing money to buy real estate or a home is in the same category. Where some of us might get into trouble is with consumer credit cards, Visa, American Express, MasterCard, and it depends on what you're using them for. Some people just have addictions almost to shopping and spending and buying more than they need, or buying more expensive things than they could really afford. So this is where we can get in trouble with debt and credit cards, particularly retail credit cards. And I'm not suggesting that it's a negative to use credit cards, but they need to be used judiciously. So one of the aspects about modern life is that we are constantly being measured and scrutinized. On this page, we're going to talk about the whole phenomenon of credit score. Every one of us who ever transacts and uses credit in any way, shape, or form, and we all should use credit. I'll say more about that in a minute. But the financial institutions are very they pay a lot of attention to what type of person you are in terms of how you handle money and how you handle debt and credit. So many years ago, there was a company called Fair Isaac. Two gentlemen, Mr. Fair and Mr. Isaac, started the whole phenomenon of keeping track of credit scores for individuals, and they do this for the financial institutions and the credit agencies. So it's called a FICO score because Mr. Fair and Mr. Isaac came up with the idea. And the average score in the United States is 730. At the bottom of this page, you see a range of scores. Anything at 619 and below is poor. Up to 659 is fair. A good score is 660 to 749. An excellent score is 750 and up. And there are consequences to your credit score. If you have a high score, financial institutions are going to lend you money at a lower interest rate. If you have a poor score or just a fair score, you represent a higher risk. And on this page, we show how your credit score is determined. And the major part of it, 35%, is based on your payment history. So it's important for all of us to demonstrate that we can be responsible about credit. So you might think that it's important to avoid debt altogether. That's not really the case. If you hope to buy a home someday or make other large purchases, you're going to need to have a credit history. So when you're ready, it's important to get a credit card or a couple of them and use them prudently and in a disciplined way. This way you'll establish your payment history, which is makes up the biggest part of your credit score. The next largest category is your income. Obviously, people who make higher income are more attractive to credit agencies, and it's important that the amount of debt that you run up compared to your income, it's called the debt to income ratio, that be in some prudent balance. You don't want to have an excess of debt compared to your income. 15% is made up of the length of your credit history. So it's important for young people to start to establish a credit history by getting a credit card or two, and like I said, using it judiciously. If you run up $1,000 a month, it's really helpful to pay it off before you're charged interest. Then 10% is made up of the type of credit you already use. So, for example, somebody who had a lot of retail accounts, one at Macy's, one at Gap, one at Best Buy, just a dozen retail type accounts, that's not going to look too good. On the other hand, if you have a mortgage loan and you're paying it on time always, that's going to go in your favor. And then 10%, they look at the number of recently opened accounts. So if they see somebody who suddenly opened 5 or 6 new credit card accounts, that's gonna make them nervous, and it's going to hurt your score. So it's important for all of us to kind of keep track of what our credit history is. We're talking about two things here. There's a difference between your credit history and your credit score. Your credit score is based on your credit history, but it's easier to get access to your credit history than it is to your credit score. So it's important to review this. So these credit agencies, Equifax, Experian, and TransUnion, you can get a free copy of your credit history every 12 months. And mistakes happen. So sometimes these agencies make errors. They confuse you with somebody else, or some things get on your history that don't belong, and we need to get those straightened out as soon as we can, because it can affect you in a negative way. anytime, another aspect of why this is all important is that many employers will check your credit score when you apply for a job. Employers want to know if you're responsible, if you can handle money, if you're a prudent risk, and your credit score is going to be part of what they might assess. So it's just another reason to take this all very seriously. If you're ever denied a job or denied a loan or a credit card because of your credit score, they are required to give you a free copy of your credit score so you can challenge it if that's appropriate. So it's really good to pay attention to your credit history. And the final point here is that you can get a copy of your actual credit score. It may cost you $20 to $30. It's a good thing to do, particularly if you ever see anything that is in error about your credit history. And we've included a website where you can do that here. So let's talk about credit cards. They're important because they're convenient. If we paid cash for everything, we would have to carry a lot of cash around with us. So they're convenient that way, and they're part of their importance, as I mentioned earlier, is that it's a great way for young people to begin to establish a credit history, to demonstrate that you're trustworthy, that you're a good risk, so to speak, that you can borrow money and pay it back. Every credit card has a limit associated with it. So for a beginning credit card, $2,000, $2,500, $5,000 might be an appropriate limit where you can't go over that. Every credit card has an interest rate associated with it, so it's prudent to do some time shopping for a good rate. Revolving credit means, let's say, for example, you have a credit card with a $5,000 limit, and you use it every month to run up $1,000 or $2,000, and then you pay that off. The revolving part means that the credit limit doesn't go away. In some cases, when you have a loan, if you borrow a certain amount of money, once you pay it off, that loan is no longer available to be renewed. But revolving credit is different. You have a $5,000 limit as long as you don't abuse it. Paying on time is important. So every credit card has a certain grace period. You need to understand that. Like in many cases, they'll say the payment is due April 1st, but it's late if you pay after April 10th. So that's the grace period. And Heidi, you wanted to share something about bonus and reward points on cards.
I did. Thanks, Jim. So you'll see a lot of cards out there with bonus miles or cash back, all kinds of different credits. And it's important to take a close look at those cards. So those cards could have an additional annual fee associated with them. They also might have a higher interest rate associated with them. So you need to look at those things and make sure it's worth it in order to get the reward that they're offering.
Thanks, Heidi. So every month a credit card company will notify you of the minimum payment due. We're going to answer this question on the next slide, I believe. Why is it important to pay more than the minimum? And a sort of rhetorical question, is paying late fees dignified? Of course it's not. It's silly to be penalized and waste your money because you didn't make a payment on time. And because of technology today, it is possible to set up automatic payments from your checking account or your savings account so that you make sure that you avoid late fees. On this chart here, we wanted to show you the consequences of different behaviors in regard to credit cards. So let's go to the very bottom, the third row there, where you've borrowed $3,000 for purchases on a credit card and you're only making the minimum payment. the credit card company is going to let you pay that off over a period of 11 years. And they actually like that kind of situation. It's good for them. It's not so good for you, because over that period you're going to pay an extra $1,745 in interest if you only make the minimum payment. So the goods and services that you paid $3,000 for over that period are going to end up costing you $4,745. That's not very prudent. On line 2, if you just make a little bit more than the minimum payment at $103 a month, you'll pay it off in 3 years. In this case, your interest is $712. The ideal situation on credit cards is if you, in this example, run up expenses of $3,000, but you pay it off in time to reach the time limit, the payment due date. You'll pay no interest. You get to borrow the money for 25 days, 28 days, and pay it off on time, and you accrue no interest. So that's the best way to go, and that kind of behavior will definitely help your credit score. So on this next slide, we want to emphasize the relationship between dignity and saving for long-term goals. Certainly preparing for things in life like saving to get yourself set up so that you could buy a home or pay for your education and your children's education. These are really positive characteristics of behavior that we all strive to achieve in life. I'm sorry, Heidi is going to take over at this point. So now we're on our final category, saving and investing.
Thanks, Jim. So as Jim said, dignity is certainly associated with saving for long-term goals. When you're saving and investing, you're looking to meet a specific goal you've set for yourself. And that really shows that you're taking your own future seriously. So you're putting time and energy into building the future that you want, and that's kind of the ultimate goal in living a dignified life. So with saving and investing, there's kind of a 3-bucket approach. And the first bucket, checking account, we've already discussed. So as you know now, the checking account is there to manage your day-to-day cash flow and to keep that money safe. So now we're going to talk about cash reserves and also retirement and brokerage accounts. So cash reserves are going to help you be prepared for an unexpected expense. Life never goes the way we think it's going to, and there's always things that come up that we didn't see coming. That could be a flat tire or a broken cell phone. It could also be something more serious like the loss of a job. So the ultimate goal is to have 6 months of cash reserves set up so that you can cover yourself in case something serious does happen. You're going to want to be able to cover all of your fixed expenses, so that would be things like rent, utilities, groceries, things like that. And you would want to keep these funds liquid, so rather than investing them and having the value of these funds fluctuate, you want to keep them somewhere liquid, somewhere safe, so that you can pull them immediately in case there's an emergency and you do need them. So a great place to do that is a savings account. So where we talked about the checking account being a day-to-day cash management account, savings account is more of a deposit account at a bank or a credit union. And typically the number of monthly transfers or withdrawals is limited, so you do want to make sure that once you put money there, it's going to stay for a little while. So this is going to keep your hard-earned money safe, and it's going to pay some interest, so that balance will grow. Another way to earn interest is with a certificate of deposit, also known as a CD. So a CD is a savings certificate that pays the owner interest during a certain term. It has a maturity date, as we said, a specific rate of interest, and it's issued in specific denominations. So it could be a CD for $100 that goes over the period of 2 years. One good thing about CDs is that they earn a higher interest rate than savings accounts do. One thing to look out for, however, is that there are early withdrawal penalties if you take your money out of the CD before the end of the term. So if you do purchase a CD, be very clear about what the term of that CD is and make sure that you have enough in cash reserves so that you don't have to pull money early. Our third bucket is retirement savings. And we're going to talk about two of the most common retirement plans, 401k and also an individual plan or an IRA. So a 401k is associated with your employer, and it's an account where you can have monies taken out of your paycheck and put into your 401k retirement account, and many employers will match part of that contribution and put money into your retirement account as well. So like we said before, this is another way to pay yourself first. You can just automatically have that deducted from your paycheck, and the account's going to grow over time. Oftentimes when you don't see that that money hit your checking account, you're not tempted to spend it, you oftentimes don't miss it. And even if you can only put a little bit into your 401k, it's still worth doing. You're still going to develop that good habit, and you'd be surprised at how quickly that 401k is going to grow over time. The second account we want to talk about is an individual retirement account, or an IRA. So again, this is another type of retirement savings plan. And this is not associated with an employer, so this is something that you can open on your own. You can go to a bank, a credit union, or a brokerage firm and do this on your own. As long as you've got earned income, you can contribute to an IRA. So in both of these types of retirement accounts, there are contribution limits, only so much that you can put in per year. For a 401k, that limit is $18,000 per year, and for an IRA, it's $5,500 per year. If you're 50 years old or older, you can contribute a higher amount, and these amounts will change with IRS rules changing over time. There's penalties if you take the funds out before age 59 and a half. Now, some exceptions apply, but in general, when you put money into a 401k or an IRA, you want to make sure that that money is intended to stay there until retirement, until at least age 59 and a half. We don't want to have to pull those funds back out. The contributions that you make receive preferential tax treatment, so you don't owe as much tax at the end of the year because they're going to reduce your taxable income. Within these two types of accounts, you can make investments, and these investments will grow tax deferred.
So Heidi, I just wanted to insert a comment here about retirement savings. I've been a financial advisor for over 33 years now, and I know over that period of time that one of the things that parents certainly are concerned about most often is being a burden to their children. So having the discipline to plan for the future, and in this case retirement, is just a crucial characteristic and discipline to develop. None of us want to be old and broke. Being broke when you're young is not the best thing, but it's recoverable. It gets a lot harder when you're in your senior years and broke. So that's why this is so important.
Thanks, Jim. So as we said, you can make investments inside of the retirement accounts and inside of any brokerage account. And we're going to start talking about types of investments, the first being bonds. So bonds are a debt vehicle. They're a debt investment that pays interest over a specific period of time. So on the left you'll see our investor, and on the right he's making a loan effectively to a company. It could be a city or a state. Here we have San Francisco, so let's say this is a bond for the city of San Francisco. So he's going to make that loan to the city. During the term of the bond, the time period where the city is going to use that money, the investor is going to be paid interest periodically. At the end of the term, in this case, the city of San Francisco will return the principal to the investor. The next type of investment vehicle is a stock. So rather than debt, this is going to be an equity investment. So when you buy stock in a company, you're becoming part owner. You have the right to dividends if the company pays them. You can vote on some corporate matters, and you can sell that stock anytime you want to. So again, we have our investor on the left. She is buying shares in the company on the right. Dividends, when they are paid, they'll be paid periodically to that investor while she's holding the shares of that company. And if she decides to sell those shares, she'll get the proceeds back. The company will pay those back to her. There are two types of stocks. There are common and preferred stocks, and it's worth mentioning that preferred stocks generally pay dividends first and generally pay larger dividends than those of common stock. The third vehicle is our mutual funds. And mutual funds are investments that sell shares to investors to raise a pool of money. And with that pool of money, they buy a basket of stocks and or bonds. So again, we have our investor on the left. She is going to pay money into the fund. She's going to buy shares of that fund. The fund manager is going to use those monies to buy a variety of investments. And depending on the goal of that mutual fund, the investments can vary. So they can be stocks, they can be bonds, they can be a mix of both. Every mutual fund has an investment goal. It could be an international fund, it could be a bond fund, many options. And investors can choose mutual funds based on the goals they're looking to achieve. Mutual funds will pay dividends periodically while the investor holds the shares, and then if the investor decides to sell those shares, the proceeds come back to the investor. So as you purchase investments, you'll notice some growth over time. Each asset class will grow differently over time. Some are more aggressive, more risky, others are more conservative. Here we're seeing the value of different asset classes. If you were to have invested $1 in the year 1900, what would the value of that investment be in the year 2000? So we're seeing gold, bonds, stocks, and the CPI, or Consumer Price Index, reflected here. And you'll notice bonds being more conservative. In the year 2000, they're valued at $93, while the stocks have risen to $16,156. So quite a big difference between those two asset classes. So each type of investment has a different amount of risk. And generally, the more risk you take, the higher the potential reward, but also the higher potential loss. So as we saw in the previous slide, the individual shares, or the S&P 500, did very well over time. We'll see them here on the higher side of the risk spectrum. So individual shares having more risk, bonds and cash on the the bottom of the chart. They're lower risk. So when you're choosing investments, you want to take your risk tolerance. How much risk can you afford to take? Do you want to take? You want to take your risk tolerance and your time horizon into account. Generally, again, the less time you have before you need to use those funds, the less risk you want to be taking. So these are all things you'll want to take into consideration when choosing an investment strategy.
Thanks, Heidi. So, in conclusion, we hope that this presentation has been useful and valuable to you and will help you to answer the question we posed here on the final page about the relationship between financial responsibility, accomplishing long-term goals, and dignity. What does that relationship mean to you? We have recorded this presentation, and it will sit on our website approximately a week from today, so you can pass this on to other folks you might know who would benefit from this. On this chart, it shows that our next webinar will be on April 29th, and that's going to be on the theme of stewardship, social impact through values-based investing. And Heidi and I are going to do this presentation. We will publish up these charts or PowerPoints as a workbook, and we're going to do this live in our office in the evening on June 17th. So we'll make sure all of you who listened in today get an invitation to that. We'd be happy to host you and anyone that might be appropriate. You can see other themes of our webinars that are in our library on our website, and you're welcome to view any of those that might be useful to you. We love it when our listeners stay in touch. There's many ways to do that, as you can see on this page right here. We would love to hear from you. Thank you for your attention today, and thank you, Heidi, for doing this with me.
Thank you, Jim.